Hey folks, welcome back to Money and Politics. We are now at 2022 and hope you had a great holiday season. I, as you probably know, just kind of unplugged and chilled out, so I wasn't doing a whole lot aside from a little tweet now and then. It was kind of nice just to have that period of time. I'm sure you had the same experience where we forget what day it is and you just have no agenda to do anything other than what you feel like doing. I wanted to talk to you about something today, and not necessarily humble, but I was asked, but before I move on to what I'm going to talk to you about just briefly, Humble at about 12:25 Central Time is up roughly 21% to 33.8 cents. That's a gain of about 5 cents on some heavy volume. It's been up even higher earlier in the day. But I had a question from a follower, and again, I don't want to bring the graphic up, but if you want to write me, it's MoneyAndPoliticsNow at gmail.com for an email. And the person wrote that they were a school teacher and they wanted to get my thoughts about putting money into a dividend stock, and they said like AT&T. So the question is, should you do dividend stocks versus growth? And I started to say, aside from the fact that I just flash, as I always do, this disclaimer that I'm not a registered broker or financial advisor, I wanted to emphasize that. So what I bring to the table is often a different point of view than what you're going to get from people who work in the financial services industry. I think at the very least, I get you to think about things. And so I want to emphasize, I'm not a financial planner. I don't know all the information that I would want to know if I were giving someone specific advice. Are you retired without kids? Do you have kids who are out of college? Do you have kids that still have to go to college? There's so many things that I can't sit here, just to be clear, and give people a good plan, especially from an email. But when someone asks, should I put money into AT&T versus for the dividend? Now, I looked and AT&T was down to about $25 a share. And what I said is that I would not put money into AT&T. And now I don't want to make this about AT&T, but more to the question, to bring up that graphic again, dividend stocks versus growth, and how should we look at that? And what I said to him was that in the last 2 years, AT&T stock was down 35%, while the TQQ, which is the 3 times leveraged version on the NASDAQ, the TQQ is up 282%. So AT&T was down 35% over 2 years, TQQQ up 282%. And as I said to him, and I would have you think about it, let's remember the big picture. The big picture is that our primary goal is to grow your wealth, not just to have an income stream. And sometimes when you look at this, like, well, as he was a retired teacher, which is an important thing, that you can have a false sense of security by saying, well, AT&T at $25 is paying a dividend of 8.5%. Well, that sounds good, but let's bring up just briefly here this chart. And as you can see, AT&T is the red line at the very bottom of the screen. I'm going to remove my logo here. And that's where it's down 35% over the last 2 years. You see, by contrast, the green line is the 3 times leverage version of the S&P. That was up 118% over 2 years. The TQQ, which is the purple line, is up 282%. And coincidentally, the InMode, which is INMD, is up just about the exact same amount because it's come down recently. But not too long ago, in fact, back around the early part of November, before it came down a bit, InMode was up 400% over the previous 4 years. So the point is, folks, as I said to him, if you had put $100,000 into AT&T 2 years ago, you may have had dividends of $16,000. Frankly, I don't think you would have had that dividend of $16,000 because it wasn't paying. AT&T had been a little higher and was paying about a 5% dividend. But let's just say that you had, for the sake of discussion, let's say you had an 8% dividend and you put $100,000 into AT&T stock 2 years ago. Well, you would have had $16,000 then. $8,000 over 2 years would be $16,000 in dividends. But because the stock value went down by 35%, your $100,000 would have turned into only $65,000. And in that case, you would have been better off just to take $100,000 and park it into a savings account and take $8,000 out a year in cash, because then you would still have had $84,000 left instead of $65,000. Now, by contrast, if you had put $100,000 into TQQQ 2 years ago, instead of it being worth $65,000, which AT&T would be today, your $100,000 would have grown to $282,000. $282,000 versus $65,000. Because as you can see with that red line at the bottom of the screen, it went down, AT&T, 35% over 2 years, where the TQQQ is up 282%. Now, if you're up 200 to 282%, my point is you can create your own dividend by just selling some shares as you go along. And that way you get both growth and you have some cash flow. Now, let me pause for a moment before anyone goes out and decides to stick all their money into TQQ. I want to remind you, as I've said all the time, but this is very important, the TQQ is a leveraged index, so it's going to go up 3 times faster than the NASDAQ. However, it's also going to go down 3 times faster than the NASDAQ if the NASDAQ goes south on us. So right at the moment, as we record this, the NASDAQ is up 0.79%. By contrast, the TQQ is up 1.86% on the day. That's a difference. And the TQQ can really grow, as can the UPRO. Again, that's the UPRO is the 3 times on the S&P 500. That is the green line there. So the thing is, I would say that remember that as you're going along, you want to be able to grow your portfolio, not just take money out. AT&T to me is a bloated bureaucracy, and it is debt-laden. So I wouldn't buy AT&T. It could be that there are some solid companies out there that pay a decent dividend, but even the S&P 500 is going to be paying about 1.8% dividend yield right now. If we were to get a market sell-off, I mean, maybe I should do a different video on this. If you buy a stock that's at, in other words, the dividend yield is going to vary by day depending upon what the stock price is, and people get confused about something that should be relatively simple. But let's just say, let me cover this quickly. If you bought a stock that was $100 and the dividend per year was $5, that's a 5% dividend yield. $5 is 5% of 100. Now, let's say you bought that today in January. It's a $100 stock and it's paying a $5 a year dividend. Again, 5%, right, on that money you put in January. Let's say we go out to March and there's a market decline and that $100 stock fell to $50, but they continue to say we're going to pay $5 over the course of the year. If you then buy that stock at $50, but you're getting a $5 dividend a year, now you're getting a 10% dividend. So the dividend, even if it stays the same, is going to go up or down as a mathematical reality as the stock price goes up and down. So currently AT&T is paying about 8.5%. If you if you buy that today, that's what you would get. But you have to look, and my larger point is, folks, let's not be enamored and go all gaga about the fact that you're going to be getting 8.5%, because how viable is the company you're buying? And as you see here, that red line is taking away the value of your holdings because it went down 35%. AT&T stock did over the last 2 years. So I just wanted to do that midday. I thought I started to give him a response, and I did respond to it, and I thought this is something that I should share with the rest of you. So again, hope you had that's a quickie. I may be doing another video this afternoon. We'll take a look at the market close. This is the kind of thing, as I said earlier in December, I want to be talking about, just some fundamental basic ideas about investing. What you should do is be talking on some of these things if you have a financial advisor. Financial advisors are different than stockbrokers. Stockbrokers will do a trade for you. The financial advisors are going to be doing more of a holistic approach and looking at how you're going to pay for your kids' college education, how you're going to retire, what kind of money do you have if you were to die, do you have life insurance? So financial advisors do a more holistic thing. So I would say, you're probably doing good for yourself to talk to a financial advisor. But a lot of times, both stockbrokers and financial advisors are doing things that I would say you want to take a second look at it and get a second opinion. That's what I'm trying to give you, a little bit of a different view. And I am not necessarily one that says just because you're retired, you should be running into dividend stocks. I would also say, before I close out here, that I would not be going into bonds, because if you buy a bond today and interest rates go up, and they will, we know that they're going to go up, the value of your bond is going to decrease. You do not want to be buying bonds as interest rates go up. The best time to be buying bonds is when we go from a higher interest rate environment to a lower interest rates environment. That way, if you buy $1,000 bond, it's actually going to increase. It might go to $1,200, $1,300, $1,400, depending upon how much the interest rates come down. These are the basic fundamental things that too often we fail to tell people. So with that said, folks, I hope you had a great holiday. I'm going to close out here, and we'll, like I say, maybe talk to you again in the near future. So give me your thoughts. What do you think of what I said? And anything else that you want me to be talking about over the course of 2022. Hope we all have a great and prosperous new year.